Yeah.
All right. Hey, first of all, I'm Paul Tyler. Welcome to our, if you haven't been here, welcome to our facilities. Welcome to the boat building. It's actually a building on the historic registry. It's kind of a unique landmark here in Hartford. And when I tell people innovation is in our DNA, it literally is. Not only for the companies we've acquired, but I think the company going forward. Nassau Re, for those of you who don't know, it's I tell people at events, I say I work for this 165-year-old startup. People like Brent laugh hysterically at this. Nassau Re is 5 years old, founded in 2015. We acquired Phoenix. Phoenix was the first acquisition. We've since acquired a couple other companies. Doing some really interesting things. We're not a big company. We probably have 350 people working in our core insurance operations. Very unique in that you can take this elevator up and down the building and probably talk to every single function in an insurance company. Now, I've worked for large ones where you'd have to get on a plane and fly, cross country and change time zones in order to do that. So it's we have a unique space for doing innovative work. We're happy to tell you more about the story, about what we're doing and why we're doing it. But I really want to focus on the reason why we're here. We have an incubator in Hartford, but we've built and designed our incubator to really complement a lot of the effort going on here. And I would say, like this event, glad you're here. I just want to emphasize this was a community event, and we'll have at the end of this, we're going to have a really interesting panel discussion today. We're also going to bring up some leaders in the community. As well as some people from some accelerators and very local interesting programs who've all kind of worked together, invite all of you, get startups. Very unique event. So as you can tell, to pack this room, we actually kind of violated some fire code issues. So we actually have this being live streamed down to the 5th floor. We tell all the startups you can bring one person, but leave everybody else below. So logistically, we'll have a panel discussion, hopefully some good questions. We'll introduce you to people who are members in our community, and then we'll have all of you kind of go down to the 5th floor. I want to introduce you to a couple of people. Laura, where's Laura? Laura, if you haven't met Laura, she's our program manager. She's phenomenal, great backstory. Have any questions or around logistics or want to meet people, she's the person to do. We got a couple senior leaders from our team, from our company at our executive level. Tom Buckingham, do you want to just raise your hand? Head of product service and marketing. And then Jackie, where's Jackie? Jackie Bannon, our chief people officer. Thank you. Thank you for the time. So with that, I want to turn the time over to Doug Roth, who's been a terrific partner with a leader at CT Innovations. And Doug, let me just sort of turn this thing over to you.
Great. Thank you very much. And panelists want to join me up here, and we'll get started. So we've got a great panel. Wherever you want.
Okay, we have two mics, two handheld. They're on. This is for the benefit for people downstairs.
Is this all of us?
Yep. Do we have enough?
We'll be more centered.
There we go. Yeah, so as Paul mentioned, the mics are for the benefit of the folks downstairs, so maybe speak loudly for the people on this floor and speak into the mic for the people on the 5th floor. Yeah, so we've got a great panel. And maybe what I'll ask them to do is sort of introduce more of their firms. We can all sort of cyber stalk you on LinkedIn, find out about your personal backgrounds, but maybe start David and down the line, your firm and sort of stage that you invest in within Insurtech, the kinds of things that you focus on.
Great. Hi, everyone. Great to be here. David Gertner. I'm with Mass Mutual Ventures, corporate venture arm of Mass Mutual, Fortune 100 life insurance company. Started the group about 5 years ago to capitalize on the significant disruption going on in Insurtech. We've got about 30 current portfolio companies, invest from seed to the growth stage with a focus on Series A to C companies, agnostic across various lines of insurance. And I think what makes us somewhat unique as a corporate venture arm is that we are returns oriented with a strategic angle. So if you look at the 30 or so companies that we've invested in to date, probably a half to 2/3 of those have some sort of commercial relationship with MassMutual. So that's our group.
Great. Thanks.
Hi everyone, I'm Adam Myers. I'm with Guardian Life and with their venture capital team. We have an $100 million fund. We tend to focus on writing checks that are between $500,000 and $2 million. That tends to lead us to Series A investments. So we are a little bit opportunistic. So we can invest in a seed stage company or something a little bit later on. Like David, working for a mutual insurer, we tend to be very strategically oriented. So financial returns are important, but strategic returns are also important. That leads us to trying to commercialize our opportunities in the near term.
Hello, everyone. I don't know if this is working. So I'm just
It's for downstairs, so there's no speaker here.
Oh.
Yeah.
For those of you downstairs,
It's just,
everyone
it's
here
just a
looks
prop,
really
right?
good. My name is George Castaneris. I am with Brewer Lane Ventures. We're headquartered in Boston. We have satellite offices in Los Angeles, San Francisco, Florida, and believe it or not, right here in Hartford. So we're happy to share that with you as well. Predominantly Insurtech focus with about, I'd say 70% of the focus being on the insurance side and about 30% of the portfolio likely to be on the fintech side. The areas where we focus our time on is engagement models, data that shifts the risk profile of understanding how to underwrite, enterprise software, and data. Those are the elements that we spend most of our time looking at, but there's always exceptions. We look at A and B rounds. Average ticket size is about 3 to 5 million. The fund is 200 million. We had our first close in December for about 60% of that, and 2 more closes between now and the end of the year that we feel very confident with, and we're up to 4 portfolio companies since we launched. Happy to share more throughout the day.
Great.
Hi, I'm Ashley Paston. I am from Bain Capital Ventures. So Bain Capital Ventures is the venture and growth equity arm of Bain Capital proper, which is a $105 billion asset manager. Bain Cap Ventures is investing now out of our $1 billion fund, and we write checks anywhere from $1 million to $100 million. So stage agnostic. I specifically focus on fintech, and fintech meaning payments, lending, investing, and insurance, with most of my time on insurance.
Hey, thanks. I'm Rick Vitone with IA Capital. Our firm's been around doing venture capital investing for about 20 years, the last 5 of which has been specific to strategic investing. We have 13 different insurance company investors across 3 different funds, and we invest $3 to $5 million per investment, usually Series A, B, C, kind of across the property casualty, life insurance, and somewhat broader fintech space.
I'm Dave Miles. Our firm is called Manchester Story. We are an Insurtech focused fund, domestic across the United States, Series Seed, Series A. We write checks of $1.5 million to $3.5 million. We have offices in Des Moines and in New York. And we have a somewhat similar model to IA Capital single fund, but we have 13 insurers. Happens to be exactly 13. I always sound a little more special when I don't sit next to him. Exactly 13 insurers that back our fund. So while we invest solely for return, we think we generate some strategic value for those insurers as well as get some strategic value for our investments as well. Thanks.
Great. So we'll jump right in. And one rule for the panelists, you can't respond with "it depends." Got to take a position. So maybe first question we'll focus on the area of talent. I think certainly on the throughout a company's life cycle, but certainly on the earlier side, talent is really critical. And we're focused here on Insurtech, right? The combination of insurance and technology, 2 very disparate areas, maybe 2 very different sort of skill sets and experience. And Rick, so maybe I'll start with you. When you're looking at an Insurtech investment, does location matter, right? So you think about like in a Venn diagram, you've got those centers of venture activity, San Francisco, New York, Boston, and then you think about where is the most insurance activity, whether that's insurance companies, insurance jobs, insurance talent. Clearly they're not completely, disparate, but clearly they don't completely overlap. And so when you're looking at an Insurtech investment, where that company is and its ability to draw locally, regionally, for the talent it's going to need, insurance and tech as well as other functional areas. How does that play into your decision?
Yeah, thanks, Doug. It absolutely plays into it. I think we're based in New York. I think New York's we're there because we're all a bunch of ex-bankers, so we happen to be there. But it's a great place to be as a venture capital firm because everybody comes through there when they're raising money. So we can see a lot of different investments, coming through day to day. When it comes to investing, we also are North America focused, so we'll invest across the country. But we're looking for firms that are not only in the Silicon Valley sort of pure tech kind of mindset. And I think that a couple of different things play into that. Our first investment was in Detroit, so you have different cost bases, but I think the topic of talent is something we really focus on. And so my partner Andy just likes to say, when he was doing fintech before it was called fintech, no one was focused on insurance. So it was not trendy to go into insurance. Insurance today is drawing the top talent all across the country. I think the ability to be in a place where you have access to the kind of insurance talent that exists is not common, and this is a particularly interesting place to be. I think the Adam Series, an old friend. I mean, the support that the city has of this initiative is really outstanding, and that's something that we look to. I know Dave and Des Moines has a similar feel, certainly, that we're jealous of, but I think the proximity to New York and for us is fantastic, and so I think the blend of insurance and tech is, this is a great spot for it, along with the support from the companies in particular. So we try to be close to the companies as well, whether they're investors or not, and I think that's a big part of it.
And maybe Ashley, if you put you on the spot, Bain obviously invests in a fairly diverse set of industries. Is there anything specific to Insurtech in terms of the geography or the types of talent that is going to make the portfolio company successful? And specific example might be, let's say AI engineers. Specifically for Insurtech, is it important for these different functional areas, the tech area and so forth, to have that insurance exposure, that insurance experience, or is it simply tech regardless of the industry?
I don't think tech is simply tech. I would say it depends on the role you're trying to fill. So if you're building, as an example, we invested in a chatbot company called Hi Marley, which sells to carriers and enables the end customer to go onto whatever, a traveler's website as an example, and say, I have a claim, and then they would basically integrate that with the rest of the back-end system. I would say the technical engineering component of that is pretty, that is not insurance specific per se, but I would say if you don't have anybody who has expertise in the selling part on your sales team in insurance, that is where it becomes more difficult. And we've seen a handful of, very bright and excited entrepreneurs trying to sell to insurance companies who don't necessarily have expertise selling and don't understand how long those sales cycles can be. And then that's where you get this catch-22 of how do you offset funding versus the long sales cycles and getting into that as a part. So I would say it depends completely on the role and how much insurance expertise is needed.
And maybe for David and Adam being strategic investors, how important is it that the companies have are located close to where you guys are, or where that business unit for MassMutual's or Guardian Life that they're going to be interacting with, getting that strategic value? Is it important that they're somewhat close by, or can they be on opposite coasts?
Should I go first because I'm holding the mic? So we have investments globally. So it's not that important, especially in kind of today's world with Zoom and Skype and all of that. I think it's beneficial and helpful when someone's down the street and can come into the office, both for us to learn from them and them to learn from us. What we find with our portfolio companies is we are able to offer them a lot of value, because especially when they don't have any domain expertise kind of on staff, because they can sit down with our underwriters or our actuaries or whoever the case may be, and actually learn about the problems and the issues that we're having, and then tailor their products for that. So I find that's probably the most helpful thing. But I find some of our portfolio companies that are located on the West Coast or even in Europe have jumped on a plane to do that.
Yeah, similar to Adam, our goal is to back the best companies regardless of, geography. Within our Boston team, we have a mandate to invest across North America and launched a Singapore group a year and a half ago to focus on Southeast Asia investing. So very global. And once we do invest, really become the internal champions to drive introductions internally within MassMutual, irrespective of where a company may be based. And I would say our investment committee is really highly engaged with the companies that will, bring to the table. MassMutual is a chief, data science officer that sits in Boston and spends a lot of time with more of the data and AI-oriented companies. And, it's easy to have a dialogue in person, but we don't let a plane ride get in the way of a potential engagement with MassMutual. So.
Great. And then maybe turning to George and Dave, George specific to Hartford and Dave to Des Moines. I mean, clearly these are two areas that are rich in insurance talent. And what do you think that the respective cities, regions need to do to be more attractive to attracting Insurtech investment, to being supportive of Insurtech companies and having all of the resources that a young company needs to grow and thrive?
That's a loaded question.
Yeah.
A couple of things. One, when we look at talent, because this is correlated to the first question that you asked, Doug, on the talent side. We typically care mostly about the teams that have personnel or characteristics of, I know how to identify a problem and I know how to execute against that problem. And when you look at the top of the funnel, when it comes to our world, we need to be paying attention to what's going on in the major cities. But what I've witnessed is the local cities like Hartford, at least in the last 3 years, which is not uncommon. Austin, I think, is another example of this. Slowly but surely, I'm seeing a lot more press and a lot more activity of cities really supporting the local community and bringing it up to par or rejuvenating it through efforts just like this. Personal experience, when I saw, I think it was 2016, Startup Bootcamp was the first one that surfaced. And, I've been here for 12 years and witnessed, building going up, debates around whether the Dunkin' Donuts stadium should go up and what that would do. I have been here for 12 years, and this is the most excited I've ever been in a space that should dominate in the insurance category. The one thing I'll add to what Ashley shared earlier is the talent specifically that's here that I think is super valuable is going to be on the distribution side as well as the risk side that I think a lot of entrepreneurs need. As far as making it more attractive, anything that makes life easy for entrepreneurs is going to be powerful. And one of the things that I witness here, and I know, and I've had conversations with folks, is how do you make it so it's easy for them to live and set up their headquarters here, and then give them access as quickly as possible to the talent that's amongst all of us. I don't think entrepreneurs are fearful of anything, the good ones at least, and being able to move is not an issue. Just make it easy for me to do that and make it convenient, and I'll dedicate myself to solving the problem. So that's the way I view it.
Thanks. I wouldn't disagree with any of that. I think what's happening in Hartford and what's happening in Des Moines, there's a lot of similarities. The Global Insurance Accelerator in Des Moines, I think the biggest the biggest impact of that was not dollars. It was the mobilization of a group of insurers who said, we will engage with you if you're willing to come and talk to us and present us ideas. And it's been, I don't think it's been a straight line. It's been up, there have been ups and downs because it's very difficult for insurers generally, I think, but particularly larger insurers, to know how to engage with a startup and for a startup to understand the world of an insurance carrier. But that commitment to engage and then creating an institutional capacity to do that year in and year out. And that's that framework, and again, you have it in Hartford as well, that framework to hold it together year after year and to continue to build on the program. I think those are essential. So in both cities, I think you have entrepreneurs coming with Insurtech solutions from all over the country. They spend a bit of time. Some of them may stay. Many of them will not stay. But being able to bring them together and have the insurers say, we will listen, we'll open our doors, we're going to try to make it as easy as we know how to make it, I think makes a huge difference.
Great. And then maybe for anyone on the panel, are there particular positions, roles, functional areas, specific talent that is harder than others to attract and retain across your portfolio companies?
I'll take a crack at that. I mean, I think right now what we're seeing as a kind of a common theme across the companies is we've got companies that have gotten to a certain level of traction, but if they have either a customer base that's the insurance industry or a great product or distribution but need commercial partners to do that, they start out with a great CEO who's gotten some traction but has sold a couple of accounts or a handful of accounts. And then it turns into this question of, is it sales, is it marketing, is it relationship management? What is that next level that is not the CEO anymore, but is someone who can take the company to the next level, either building relationships with insurance companies who getting a proof of concept has gotten easier and easier, but really building out a relationship and bringing in long-term contracts is as hard as ever, I think. And so I think that's the role that we're trying to play a bigger role with helping them build out.
George, you want to say anything? Or?
Yeah, I was actually, and maybe I'm just starting a little bit slow this morning because I didn't have any coffee. But I was thinking of something else that would actually make a huge difference, and I learned this just through my own professional career in the local community. I never expected to be here today to visit with 30 different startups. I really didn't. The amount of talent and network that's available to us here within a 10-mile radius of exactly where we're at is enormous. If we found the 3 companies that we want to back, and don't take that out of context because this serves the needs of everybody, and one of the things that I've done in my career is manage massive distribution teams. Success breeds success. You pick 2 or 3 that end up becoming those mega hits, you will attract people without much effort. And right now we have 1 unicorn in the state, maybe. We get 2, 3, 4, and it's with the capital is just the smallest piece of the equation. It's a pain, but it's the smallest piece of the equation. The rest of it is, who do you know? Do you have the right team? Do you have the right problem? Everything else. So that's
Yep.
what's going through my mind.
Great. Yeah, please.
I just want to follow up on that because I think what George is saying there is very important. When efforts get started to build an accelerator or an incubator and start to mobilize insurance carriers, I think early metrics, which are how many applicants do we get to our program, and then how many of those applicants, make it to, most of them do make it to pitch day, and then maybe, how many get a first round of funding. I get all of that, and I understand you have to build the foundation and walk before you run, but I think it's really important for efforts in a community to lead to companies being successful. And that means actually growing, getting to scale, getting an exit. that moves the needle so much more than this many of our companies got funded at least to the next round and had at least the beginnings of a life. That pretty soon, that's great to start with, but pretty soon it's not enough. And George just triggered that thought from his comments. So,
Got it. So maybe we'll switch gears a little bit and to data. And I'll make the assumption that sort of the deal flow that we see is somewhat similar to what you all see. And we see a lot of companies where data is kind of the core of what they're doing, whether it's sourcing or accessing or creating new sources of data, coming up with smart ways of analyzing data through AI or ML, and trying to find that signal in the data, or figuring out really creative, innovative ways for data to then be used and plugged in directly into the insurance business model, wherever that might be, whatever function. And what we've seen in a lot of other industries that have gone through some sort of digital transformation, and I think most industries have gone through that, others are still going, there's some holdouts. Some of the early adopters begin to see that data and monetizing data becomes a bigger opportunity than their core business. A great example is the grocery industry, right? I mean, it's a very low margin, putting products on the shelves and just having them churn. And there's a fairly large North American grocer that had realized through their affinity programs and their point of sale data that their knowledge of individual consumers is massive. And the value of that data in other industries, say the ad tech industry, was a more profitable revenue stream than their core business of being a grocer. So I'm kind of curious, in the insurance world, are you seeing either now or sort of your early bets today that will be 5-7 years from now paying off? Are you seeing digital transformation creating opportunities for data to essentially be the business, or certainly to fundamentally change the way we view insurance today? Yeah.
Yeah, so I think you hit the nail on the head there in terms of, especially when it comes to distribution strategy. We've been looking a lot to the software players that are embedding insurance into their offerings, because if you think about, I mean, let's take Toast as an example. I don't know if you guys are all familiar with Toast, but it is a restaurant management system which has embedded payments into it. So essentially, if you're at a restaurant, they can tell you, you've had, the table 4 is waiting for a check and table 3 is allergic to dairy, whatever it may be. They have payments as part of their stack and monetize off of that. They recently launched Toast Capital, which enables them to lend to their merchants, because if you think about it, they know how many coffees you sold on Monday versus Tuesday. Aren't they, in the best position to offer that customer a loan? And I would say the next step of that, and I wouldn't be surprised, and obviously there are regulatory hurdles, but I would surmise that in the next year, Toast will offer business loans to their customers, because why would you not, right? You have a sticky relationship with their customer. It's zero CAC. You already acquired them, and you could have added monetization abilities. And we've seen this starting to happen a little bit in, for example, Tesla. So Tesla, obviously, car manufacturer, and now they've been embedding car insurance, because who knows a Tesla car better than Tesla, right? I mean, they know how the tires work, how the car works, who the driver is. So they have been selling car insurance as an extra monetization capability. And we believe that in the future, distribution specifically will be coming through software players rather than, the mom and pop agency, which, as you well know, my dad and my family, I've had insurance agencies in my family since 1905, so it doesn't really bode well for them, per se, which is an always awkward conversation at the dinner table. But yeah, I mean, I think distribution through software is the future of insurance. So.
Well, Ashley's shutting down her family business. I actually do. I don't think it's as advanced as you just referenced with the grocery store. I think Tesla's a great example. We see data companies coming in two categories, and one would be, let us show you how well we can triangulate the population that is our target audience, and in that fashion, we will reduce the cost of acquisition. But it's hard to prove. The second one is we have set up proprietary data lakes with a combination of proprietary info and external data resources to better manage and understand risk for XYZ. And one of the things that I've witnessed, at least in visiting companies and looking at so many different approaches, I think it's still early in the Insurtech world as it relates to data taking over, but it's going to be critical. Because if you think about the industry, it grew up with data being something it protects, and the world is migrating to data as something it can capitalize on and commercialize. So it's coming. I just don't see it as vibrant as some of the other categories that we're looking at.
I'll maybe take a slightly different approach to what Ashley said. I generally agree with you, and I think that there's a segment of the market where they're only going to buy online digitally and kind of in the manner that you suggested. If I think about our business at Guardian Life, primary business is selling wealthy individuals whole life insurance policies. And a lot of that is driven by financial representatives, and we don't necessarily think that that is going to change significantly in the future. We think that the agent is kind of a critical piece to that. Not the only piece. I think there's probably more of an omni-channel view we can take of that, but I wouldn't necessarily say for some of the very complicated estate planning issues that we deal with that piece of the business is going away. So what we focus on is how can you use data, whether that's internal data or external data, on better leveraging our FR's ability to be productive, find relevant people, offer them products at the right time that are very well suited to their needs. So I think it's more about, part of it's certainly like how can you find relevant customers to lower their acquisition costs, but how can you make the conversation more relevant as well?
Yeah, just a couple of brief comments to add on to that. When we're evaluating businesses, really not just looking for unique data assets, but how is the data differentiated? What's a company's edge, and why can they underwrite or price more uniquely than any other players in the market? And I would say, tacking on to Adam's point, MassMutual has a technology called CoverPath, which is really intended to enable advisors, bringing down customer acquisition costs. How do you target more effectively? And to the extent that there are technologies enabling advisors to be more effective at selling policies, that's an area that we've historically been excited about. So the mix of data, but also the human component of sales.
So maybe touching on something George said, do you believe that there's an evolution of how data is used in insurance? So maybe it starts out just providing some efficiencies or enhancing the UI, if you will, then finds its way into pricing and underwriting. Eventually, it matures enough where an insurance company can offer new products and services because it now has access to data it didn't have, or the ability to analyze data that it couldn't do before, and then maybe a more fundamental change after that. Do you believe there's an evolution? And if so, where are we in the insurance industry? George obviously says we're certainly earlier than a Tesla. So where are we in that evolution? And I guess maybe another part of that question is for an Insurtech, can they leapfrog over where an insurance company is, or are they basically being dictated by the insurance company and that evolution, and you're not going to get them to move any faster?
Okay. I think evolution is kind of a good word. I always find it humorous when we consider using data to underwrite as Insurtech, right? That's only been going on since I think the year 1660, right? So, but I would still say data is kind of early. So, and it's a huge question. I'll just say two things about it. I think the industry has always treated its data very proprietarily, as George said. Historically, a lot of that data has been housed in industry utilities that were created either through industry associations or another outside party that convinced the industry to contribute its data in sort of an anonymous way. And the idea that the industry is now opening up that data to the people in this room is extremely new and extremely important and exciting, and why I think it's at the early stages. We're involved with enough companies to know that the concept of AI is very early in every aspect. And so even the way the regulators think about it, right? We can create the use of data in a way that a regulator is going to look at it and say, you're trying to circumvent the rules. That's not a great outcome, right? And so I think it's evolving in just literally every aspect of it. I mean, every company we touch across underwriting, claims, distribution has a data component. I think the fun part of our job is interfacing with big companies and with small companies on how do you think about your data, what's proprietary, what's public. And I mean, we're seeing a lot of companies whose sole business is aggregating public data and selling that. So it's just a huge question. It's the fun part of our job, and I can't go too much farther without the next 45 minutes going by. So, anyone else?
Yeah, I would agree with that. I think you know, and it depends where you're thinking across the insurance life cycle. But you know, I think where we're focused is in a couple different areas. Where does signal lie? So what data can contribute additional signal to whatever prediction we're trying to make, whether that's on the acquisition side, underwriting side, or something else. And then companies also that can help us utilize more of our data, which you know, Rick, as you mentioned, it's kind of like trapped in legacy systems in many cases. You know, are there companies out there that can help us access more data so that we can then have more data, better signal, and ultimately use that in a positive feedback loop to improve our decision making?
I wanted to, as we were talking about this, I was thinking there's an opportunity here that I hope no one's missing as entrepreneurs. If you look at the insurance sector over its history, 100+ years, data was protected, it's private, it's mine, I'm not sharing it with anybody, and it was never intended to be commercialized. And that's been going on decade after decade after decade. So you have these massive behemoth balance sheets that have data that, quite frankly, arguably, relative to a startup is a bit of a mess, because the startup is waking up in the morning thinking of a clean slate, and let me see if I can manage this risk a little bit differently. That startup, if you get the right signal and you get the right information with the way you're doing it, and you can prove that your process is better by leveraging the data this way, that's super valuable to the incumbents. Trying to retrofit good data in a bad data environment, not because of anyone's fault, just because of 100 years of time going by, it's a massive opportunity on the acquisition side, on the risk side, on the processing side.
And so with a lot of industries where data is becoming much more prevalent, right? You can have these data networking effects, right? Where an offering becomes gains a competitive advantage because of their use of data that attracts users or customers. They contribute more data that gives the company even more competitive advantage, so on and so forth, until winner take all. Will we see that in insurance? Could that exist in the insurance industry? You're nodding your head, so you have to answer.
Absolutely. I think that's kind of the fundamental thesis that we're operating under, that the companies that have the most data with the most signal will ultimately have significant advantages, because they'll be able to price more aggressively or make better predictions, have better customer service, whatever the case may be, and ultimately that'll flow into that positive feedback loop, and their data will continue to get better. They'll get more of it. They'll have better signal. And so, yeah, I think the answer is yes.
And are there data sources that you think are off limits? So, you know, your life insurance, if I start tapping into people's social media, social network platforms, and with computer vision start analyzing their Instagram pictures to see, are they engaging in a dangerous lifestyle? Would you ever use that kind of data in a pricing? And I don't want to put Guardian Life on the spot in terms of that, but just to be provocative, are there data sources that at least right now, the insurance industry is not going to use.
Yeah, I think there definitely are. There's obviously regulatory issues, especially with the Department of Financial Services circular that came out, I think in 2018. But really, the way I would answer that question is more about auditability and explainability. So yes, there's certain things that our privacy lawyers would not have any comfort using today, like social media data to underwrite an individual. But I think in the long term, when you think about where the industry is heading, there will be more data that is ultimately used to underwrite than there is today. The key for us is being able to prove that we are not discriminating, right? And so auditability of our models is really, really something that we're focused on.
Great.
Just to add to that, in life insurance, as most may be aware, the age-old question of are you a smoker or not is a really difficult question to validate. So to the extent that, when you're buying life insurance, there's no incentive to kind of be honest. And, from that regard, not speaking on behalf of MassMutual, but trying to, validate that in a way that is compliant from a data standpoint is actually a really difficult problem and challenge. So to the extent that there are unique ways of validating that information, that's a big problem.
So maybe switching gears again, and we'll focus with the far side of the panel, and maybe come back to you guys. So the idea of you're a young company, you're trying to raise money, and it's really hard to raise money. You'd like to have a long list of suitors, investors, but sometimes you have to take the money where there's interest. And one of the issues is, do you take money from a strategic? Does by having an insurance company on your cap table enhance the company, or does it create problems? Either problems doing business or problems upon exit. Across your portfolio, any thoughts on strategics on the cap table? Absolute no, or maybe I'll let you say it depends on, but you got to explain the situation.
It depends.
Yeah.
The way I think of it, I think it would be a rare case in our experience for it to be a positive for a strategic to be the lead in an early round. I look at being on the cap table, particularly if there is more than one potentially strategic investor on the cap table, but not in a lead position. To me, that's very different. We've experienced that, and I think it's been fine. I think it's been fine. So we don't have any absolute rule around it, but for a strategic, for a CVC to take the lead in an early round, I'm not saying it's something that couldn't be overcome, but it creates a real challenge as you're trying to sell to their competitors as well, as to what sort of information are they going to somehow absorb, regardless of whatever walls you attempt to create, and position themselves advantageously to me as a later customer. That's the way we think about it.
Yeah, I think we completely agree. We're very supportive of it. I think it's very supportive of having strategic. We have tons of friends in the strategic community who are CVCs, and we work very closely on a lot of different companies. I think the company needs to be cognizant of those issues, though, and in terms of how do you interact when they are competing with each other, what information do you share with different parties who may all be investors, but yet you might not want to share some information about the products or margins and so on among the competitors. So those are the kind of things that we work through, but we're very supportive. It's a very collaborative community.
Totally on par with those two folks, but I would just say there's two elements I'd want to highlight. One, I don't think it's an issue if a corporate leads around, but I think there becomes a question when it comes to ownership. So if I'm talking to a series, A or B company, and a strategic owns 45% of the company, my first thought is like, this company's likely going to get acquired by them over time, and then we can't meet our returns threshold per se. And that's something that's always in the back of my head as one point. The second point would be if you're going to a Series A and a corporate has led your seed deal, for us it's important to see that you have another corporate client, at least a POC, because then it becomes like, is your only one customer this customer because they are the lead, or do you actually have a product that is adding concrete value to your end customer? And so it's okay to have a strategic, I would say, as long as you have another carrier, whoever else your end customer is, around the table to validate that your product is, adding value to the end customer.
Just one more quick thought on that kind of vein is what we have real problem with is, and a lot of insurance companies think this is a great idea, we created this company internally and we want you to come in as an investor and then we're going to spin it out. That rarely works.
Agreed.
Can I ask a question on that one?
Yeah.
What are your thoughts on that? Why it doesn't work?
Well, first of all, we're used to being, a lead player in a round where we're coming in usually as one of the largest investors, but in a minority context. So the instinct of a company that incubates a company inside of it and spins it out is, you'll come in, we'll own 80% and you'll own 20. Isn't that okay? No, not okay. And so it's just, I don't want to say you can't have an entrepreneurial spirit inside of a big company and spin it out. And one of our last investments came out of a big company, but it came out of a big company in a way that the outside investors owned 80% of it. And the CEO has a big stake. We want the alignment of the interests to be with the management team and with us. And most companies that start Insurtechs inside are doing it because they kind of want to still control it. And that just fundamentally isn't something that's going to work with us.
I don't have anything that I would disagree that was just shared, but I did recall something that went through my mind when I was running a strategic for Prudential. It does depend, but put that to the side. One thing I would argue is that the magic's always going to be in the middle. If you look at big incumbents and you look at their balance sheet and then you took a side step and looked at a balance sheet for a startup, they're incredibly complementary. And if you can get them both to work effectively, you could actually create something powerful, incredibly powerful, because they need each other. But because the cultures are so polarizing, in more cases than not, they don't end up working as well as they should. So hopefully that changes over time, because I've seen more failure than success. And I thought I'd add that since that question was asked, and there's an element of that in there as well.
Do the strategic investors want to chime in?
So I obviously, I don't think it's an issue, but I'll approach the problem slightly differently. I think there's some companies that have really interesting, disruptive technology, but haven't gotten a lot of traction in the industry, can be better suited to have a strategic on their balance sheet because, generally speaking, when we invest, we like to use things commercially. It greatly increases the chance that Guardian actually signs whether it's a pilot or a commercial contract with that company. Puts a lot of internal pressure on kind of our colleagues. And so for that company that thinks they have really disruptive technology, but for whatever reason the industry hasn't adopted it yet, I think that's when we can be most helpful. I think when there's something that is kind of viewed across the industry as helpful and is being put into production, there's less of a need for a strategic.
As I highlighted briefly earlier, when MassMutual Ventures was stood up 5 or so years ago, it was done in a way that was very intentionally meant to be returns oriented. We report to MassMutual's chief investment officer and really investing for financial return. So that is very much the ethos of our group. And I'd also add we don't do a lot of seed stage deals. We started off doing more seed stage investing, and realized from a bandwidth standpoint, just very difficult for us to do that effectively given just time constraints. And when we're looking to invest, like to see a number of customers that are sort of arm's length away from a engagement standpoint, and it's not just one big chunky engagement with a carrier, which gets us, more comfortable with the stage at which we're investing. And then I'd also add, we will very rarely go into a deal alone. We've co-invested with a number of both strategics, but also tend to have, more traditional private VCs joining syndicates or us coming into syndicates. So that's, again, very, very intentional.
So we're going to have some time for Q&A. It's a great opportunity to ask 6 very experienced investors a question. So think about those questions now, and I'm going to just give them sort of one more question. We'll call it the lightning round. So you see a lot of companies. You hear a lot of pitches. What are some things that are just deal breakers for you? What are situations you just won't get involved in, or something an entrepreneurial team says or does that takes you from the edge of your seat to a quick and easy pass? And I'm happy to go first if that helps. So, so for
don't know what the threshold
yeah. So for us, we have a real problem with like husband and wife teams, family teams. I think we invest super early, and there are so many challenges and difficulties that young companies are facing, that injecting the additional challenge of personal relationships within a very small entrepreneurial team just is adding it's adding too much risk.
To add to that, we also have a problem with that, but ironically, we've backed 3 husband and wife teams.
Exceptions to every rule, right?
So it depends, I think. But to add, I think there have been some valuation precedents with a select group of companies that I think sets a sort of unrealistic sense of reality and valuation with entrepreneurs, and that makes it difficult just in terms of sort of a bid-ask spread, and other investors that may have a different philosophy around underwriting and returns and all of that. So sometimes a high watermark can be frustrating and difficult to wrap our heads around at times.
I don't have anything so controversial on this one. I think really, like management ownership and making sure that they've got enough stake in the game. When you factor in dilution in further rounds, we've seen some companies come in where, for AB rounds, management just doesn't own enough where they're going to continue to be motivated. So that's probably the biggest deal breaker that I've seen on a repeated basis.
I'm actually looking for something, real controversial. I would tell you, when I sit at the investment table and make determinations, I'm providing my opinion. The things that I'm looking for more than anything when someone pitches is, do they know their numbers? But not the numbers as it relates to their own company. Do they know the industry numbers? And then I pay very close attention to whether or not the entrepreneurs are good at listening. Because I grew up mostly on the front lines, if you're not able to connect and engage with people, it becomes a challenge. And then I look at team dynamics. Do you stop and shut somebody down in the middle of the conversation? You could have the best solution for one of the biggest problems, but team and leadership, in my opinion, are the key driver, and then timing. And that's what I spend most of my time paying attention to. How do you interact with each other? Are you listening? Did you listen to the question? Or are you just constantly telling me the same thing you've been saying to somebody for the last, 3 months? And those are the things that I watch for.
You took mine. Mine was.
Ashley's too.
I would say, back to your point, it's the team bickering I've had happen where there's 2 co-founders and one says something and the other one says, no, that's not right. Let me just rephrase it. And they talk over each other. And the thought process is, if you can't be amicable in one 45 or 1 hour meeting, like, I can't even imagine what goes on behind the scenes. And then as a result, how do you build a culture around that, right? If you're an employee and you see your 2 co-founders bickering and shutting each other down, I wouldn't want to work for that person. So I think there are ripple effects beyond just the obvious dynamics between the 2 co-founders.
Well, I'd say one of my pet peeves is, and I think a lot more people come in saying this than you would think, but if you start with the premise that the insurance industry is stupid and that's why you're here to innovate it, you're going to have a tough time. And that's not just because have a bunch of insurance company investors and I've been working a long time. Like, if you don't understand the industry is slow, it is regulated, it has a lot of things, but stupid's just not the right thing. And so don't have that be the premise of your company.
It's a little hard to top at the end. I'll add mine, but as I listen to my colleagues up here, I think to me the abiding lesson is it's like getting a bill through Congress and signed by the president. There's a million ways that it can come off the rails, and only one path where you actually get funding. And so it's kind of amazing that anybody ever gets funding at all. It is a very difficult process. The one I would add is where it becomes apparent at some point in the conversation that the founder or founders have fallen in love with their particular solution instead of having a commitment to solving the problem. And somewhere they've kind of forgotten the problem part. But we've worked on all of this so hard. We'll find a hole that we can push this solution into, and just give us some more money and that'll give us some more time, and we'll find it. And unfortunately, that happens. I understand it. I'm not critical. One of the reasons, I'm guessing this might be true for everyone else up here, but one of the reasons that I'm in this business is I love dealing with people day in and day out who have this incredible idea and passion, and they believe as passionately as they can that they are going to change the world for the better some way. And that is the really cool part of it. The bad part of it is usually between the start of the conversation and the end of either that one or a couple or three more, we're not going to take that journey with them. But that's just kind of the nature of the beast.
Great. Well, I'd like to thank the panelists, and maybe we can give them a round of applause for their effort. Thank you. And Paul, do we have time for one or two questions? I don't know if there's any questions. Please, and if it's directed to someone, whoever answers, maybe we could repeat the question so the folks downstairs could hear it as well. Please.
Not directed to anybody in particular, but as investors, how would you guide a startup or an early stage company that's looking to raise capital, how to think about valuation of their business?
So the question's about how does a young company think about valuation when they're going out to raise funding?
Since I happen to have the mic, I'm happy to give you an answer that I don't even find very satisfying myself, and I think most entrepreneurs probably don't either. But if I had a list of 5 priorities going into a conversation with a potential investor, it would be at best the 5th one if it made the list. And I don't say that because, well, we've got this secret way of valuing things and we don't want you to know how to do that. It's if the team is right and the market is there and there really is a problem and you've got a reasonable solution, we'll get there. And in fact, probably the investor is going to take the first go at it, but that doesn't mean you have to accept what it is. You can spend a lot of time in a room by yourself, sort of amping up your anxiety over, well, what's the valuation here going to be? And you don't need to worry about that question yet. And again, I'm not sure that everyone finds that a very satisfying answer, but it ends up being really important. And you can always find an entrepreneur that says, oh gosh, I undervalued this at the beginning. We were a big success and I only owned 11% of it and I should have owned 57% of it. You will get to that conversation, and then you want to have your best advisors around you and you want to run the numbers, but I just don't think it's something you need to think about very hard at the beginning. Maybe others have a different perspective. But
Yeah, I mean, I just say, we're talking here at a very early stage companies, and I think at that stage it tends to start with how much money do you need to raise, and then if you can't justify to someone that for taking that amount of money, they should only get, this % of the company, that's going to be hard. And so it's talking about the size of the opportunity and that sort of thing. And then when it gets to us, it's already had a number of iterations of that. And my advice is usually just don't get ahead of yourself. You're not really helping yourself by getting a valuation that's too far ahead. That's self-serving. Is come on, self-serving?
Yeah.
But,
I would never say so.
Do we have time, or
Maybe one more
maybe
question.
one more question? We'll wrap things up. Yeah, please.
Sudha.
How do you actually, the startups, how do they balance the scaling issue with the companies, the insurance companies that are very slow to adapt, going from a proof of concept or pilot to an actual contract? And this has become a real challenge for startups like myself, including, to raise money because it's a long sales cycle. And not all not all startups are in the distribution side very attractive. Some are on the other side that may not be that attractive, so it takes time. And I'm not saying companies are stupid, but each, the companies, the insurance companies also need time to understand how this is actually going to fit into my process and how am I going to operationalize these things. So between this, I think that the startups are suffering this on how do I go and pitch, this to a company to a VC company and tell them I'm doing a pilot and this pilot is running for almost 2 years now. How do companies like us balance that messaging?
Yeah, that's a fair question. I would say.
Okay, sorry, can you just repeat the question for? Yeah, sorry. And, Shri, your question is, man, long cycle. You need some scale in order to be successful, but these POCs are very, very long. You need some very patient investors. How do you get them? Is that fair?
No, that's I think the hardest question that we deal with, especially with companies at the early stage. I would say the first question, just to step back a bit, is make sure you're selling to the right person at the carrier and have the right person on your team, because ultimately I've seen a handful of startups who have sold to somebody they think is the decision maker who is not the decision maker, and then you're stuck in a POC forever. And I think that making sure you have the right person who's able to move it from pilot into an actual contract is absolutely crucial. So that's like the baseline advice. The second line of advice is, I would say, I hate it depends. I know you're told not to say that, but when there is a product that people see clear ROI to quicker, there tends to be a faster uptake as one part. The second part is you don't necessarily always need to go after the top 2 or 3 carriers. There's a way to go a little bit down market and try and upsell. And for investors, if I see, even if you're not in the top 5 or 10 carriers, if you're in the top 20 and I see that they've expanded you from 1 business unit to 2 business units, even if it's a pilot, it just shows that something's going right? And then that gives me confidence. I don't think there necessarily has to be the full contract in place. Obviously, that depends on the stage you're at, though.
Great.
All right.
So thank you again. Appreciate your time.
Thank you very much. And why don't you stay here for a second? And maybe while I've got a couple commercial messages, but Michelle, Greg, Stacy, do you want to come up here just quick and come and grab a mic? All of you, feel free to stay here if you want. You've got a seat. It's comfortable. Let's give you some mics. One of our missions here, we've only been doing what we're doing for about a year at this point. Jackie and Tom and I, kind of said, okay, well, what are we going to do and how are we going to do this? One of our major goals is to compress that sales cycle by really good introductions to companies and people here in the community who will actually say yes, and they'll say yes quickly. And as Dave said, man, if there are a lot of ways for funding to blow up, trying to get a contract with a carrier, oh my God, it's a journey. So we're really trying to tell the stories of the startups. So ask number 1 is subscribe to our podcast. It's Reimagine. If you do, we have free stickers downstairs. They're really cool. You can put them on a laptop. We have interviewed every startup in our program, the new ones that will be coming on, including startups in the other programs in the Hartford area, with the intention of giving you like 20 minutes with a person in depth so you understand the backstory, what they're doing, what the problem they're trying to solve, and so subscribe to that, and you'll get sort of a regular feed of what's going on. Second one, ourselves, we're actually doing really trying to push the envelope ourselves. Second request, download our new iPhone app available in the iTunes store. Tom and I just launched an iPhone. Sizzle here is we've actually decided as a leadership team to try and skip over a couple of generations in the evolution cycle. So you got a poster over here. The sizzle on the app is you can buy a fixed annuity in probably like 5 minutes. And now what's the problem is, God, there are a lot of people who are about to retire. How do you get higher interest on your savings? Okay, in those later years. So this is a product. You're 55 and up. It's a great product. We've got a great rate. The bigger problem is we want to take these high rates we have, make it more accessible to more people. So the more sexy part's the iPhone app. I think the more interesting is we've actually taken the minimums down, and we're not only going to make it more accessible, but really try to help people understand, the value of stuff as basic as compound interest. Would you like to have your money grow faster or slower? So we're doing that. Love any of your feedback. So next, just a quick intro. As I said, thanks for being here, but I just want to emphasize this is a huge community effort to get all of you here, startups, investors, everything. I want to introduce you to some of the, just quickly give you an intro to people who are sort of leading change. And first, Michelle, can you tell them who you are and what you do here in Hartford?
Thanks so much, Paul. So my name is Michelle Cody. I lead an effort called Launch Hartford here in the city that was catalyzed by some seed investment from the state of Connecticut to help communities across our state really envision new ways of becoming visible and vibrant hubs of innovation and entrepreneurship. So I was asked to lead a group of folks in developing a strategy for how Hartford could become one of those places. And I also teach innovation and entrepreneurship at the University of Connecticut School of Business. I work with students and faculty from across the university and trying to bring new products to market. So strategy 101 is identify your strengths, right, first, and figure out what you can build on and how you can differentiate yourself from lots of other people trying to sort of do the same thing based on the strengths that you have. So it was very obvious to us very early on that to do anything differentiated in Hartford and authentic in Hartford, we'd have to engage our anchor industry. So insurance, healthcare, advanced manufacturing, and figure out how to build an ecosystem that would invite new companies that are trying to do business with each of those different industries into our city and create value for our incumbents that are in each of those different industries to be able to maintain relevancy in the marketplace and ideally be able to grow through innovation. One of the things that I don't think that we realized early on, but what we have learned in the past 3 years of doing this, is that one of the biggest strengths that we have is our size. We are a small city that is very, very connected with amazing relationships amongst people from various backgrounds, perspectives, and have assets to share. So when you think about the innovation ecosystem that has been taking shape very rapidly here in Hartford, it has been because of lead investment by our anchor corporations, Aetna, Cigna, Travelers, The Hartford, Nassau Re, Stanley Black & Decker, Hartford Healthcare, and we could go on and on, but those are the founding members. But it's also been the other institutions and stakeholders that people maybe don't get on board in other places. So the University of Connecticut has figured out how to offer new classes. Like we have a new class at the center that I work in around how digital technology is transforming insurance. And we have graduate and undergraduate students taking that course and getting really excited for the first time about career opportunities and leveraging analytics and AI and all sorts of digital capabilities and going into the insurance field for the first time. We have property owners like Shelbourne Group who have really catalyzed the development of Upward Hartford and Upward Labs and said, how can we utilize the space that we own in the city differently? We have insurance professionals like Stacey Brown who have been sort of sweating the problems inside of an organization and saying, okay, how can we figure out how to organize activity amongst other professionals and stakeholders to really create critical mass in this? And then we have entrepreneurs. Anurag Shah has recently recently joined our board who have come to the city of Hartford. He recently moved his entire family to the Hartford area from India to be able to pursue the market opportunity here, which is amazing, and is joining our board and saying, let me figure out, in addition to growing a company, which is challenging enough, figure out how to give back to the ecosystem. So it's really been gratifying to see everybody come together and create a lot of activity in a very short period of time in a very concentrated place to build momentum.
That's great. And Greg, can you talk about Upward Lab? And first of all, thanks. A number of your startups that you'll see today actually come out of Upward Labs program.
Yep. All right, fantastic. Thanks, Paul. So everyone, I'm Greg Flynn. I'm the program director over at Upward Labs. So we are a startup lab based here in Hartford. And the way our program works is every 6 months we take 10 startups from all over the world to come through our program. We have 2 areas that we focus on. So one area is property technology, and the other area is aged care technology, so advances in senior living. A lot of our companies have heavy crossover over into the Insurtech world as well. And when our startups come in, we do a couple of things with them. So one is the lab portion of Upward Labs is we are a pilot lab. We run every startup that comes into our lab is guaranteed 2 pilot partners with a list of marquee pilot partners. So Shelbourne Global, for example, which owns a lot of Class A commercial office buildings, 100 Pearl Street here, 20 Church Street. Shelbourne Global, for example, is one of our pilot partners. Hartford Healthcare, we just signed Hartford Healthcare as a pilot partner as well. So everyone who comes in gets 2 pilots, and that's an opportunity for the entire ecosystem basically to see these startups in action. The second thing we do is we have 30 corporate partners who are associated with our lab. Paul and Nassau Re are a corporate partner, Travelers to Hartford, Cigna, Aetna, Stanley Black & Decker, Lincoln Financial, you name it, all the corporate partners. And the thing that's unique about our program is that, and this is getting into the ecosystem, if you think about it from a corporate partner's perspective, you would ask one question when it's working with a startup, right? How do I know I can trust these guys, right? It's a small company, lots of startups come in, they can overpromise and they can underdeliver. So we created a program which effectively allows all of the corporate partners to watch the startups in action through the pilot. The corporate partners are basically looking in as our startups pilot their technology and saying, boy, does this really work? Does this deliver value? Is this something I can use in my organization and what have you? So we end up at the end of the program, at the end of the 6 months, which is the amazing part of our program, with not only have our startups come in and piloted, but then they've got a huge list of corporate partners that are interested in doing the exact same thing within those big corporations. And that's a very unique innovation that we have, and quite frankly, I think it's very relevant to an investor group as well, because not only do we have startups, right, who've proved themselves as they've made through the program, they also have a significant amount of commercial traction with a lot of the large insurers. And then the last piece we have is really in and around raising capital. So we help our startups prepare to raise capital. We help to get them ready. This event is absolutely phenomenal for us because to have the network and the investor network now develop in and around Hartford for our startups is absolutely priceless. And so from that perspective, look forward to getting to know a lot of you more in the coming weeks and days. One thing I will say too is that if you want to get a chance to know our program, April 2nd is our demo day. So we have it coming up. We're going to have it. We do our demo day. It's kind of like a festival is the way that I would put it. So it's not a traditional demo day. All of our startups are going to have really detailed exhibitions in their technology. They're going to allow you to kind of feel the company, feel the power of the technology and what they've built in a very immersive way. And so I would encourage all of you to consider it. I'll make sure I send out invites to all of you, but would certainly love to have you join. So that's our program. That's Upward Labs, and would just like to say thanks again for being here today.
Yeah, and then thank you, Greg. And then Stacy, insurance executive by day, power organizer by night. You have, in fact, tonight he has a pitch night that is sold out. Is that right?
It's never sold out, but it'll be great attendance. And Stacy Brown, almost 20-year veteran in insurance technology industry here in Hartford. And saw the trends growing in Insurtech a few years ago. At the time, there wasn't much happening here, but I wanted to be a part of something, so I just started having events. And since then, kind of continue to do that to this day. We've grown in terms of scale. We've done a lot of different types of things, whether it's hackathons, pitch nights, etc. We've been able to help be the glue to a lot of what's going on within this community, and helping people to have something to engage besides just, if they're not in an accelerator program or they don't work for an anchor sponsoring company, how do they engage and how do they become part of the ethos here? That's what we help to do. So three main things that we focus on. One is running events around networking. So we have a networking series tonight, like Paul mentioned, is one. It's looking like it's gonna be a really great event. Hope to see many of you there. Hope to see all of you there. Second thing we're doing this year is I'm happy to announce that we just signed contracts last week with the Marriott right across the street there to run the Insurtech Hartford Symposium for the second year. Last year was really great. We had almost 300 people. Energy was super high. People loved the content. They loved the engagement. They loved how it was small. You basically made eye contact with everybody at some point in time during the event, and so we're really excited to have that happening November 16th, 17th this year. And then the third thing that I'm really happy to update you all on is the progress we're making in launching the Innovation Challenge. So this was another opportunity that we saw within this community, because there is so much talent here and there is so much access here. It'd be a great place to run an Innovation Challenge focused on insurance. We just got our first insurer commitment last week to helping be a sponsor of the program. We're in the process right now of trying to line up those sponsors and partners. So from a VC perspective, investor perspective, maybe there's be some interest from some folks in the room. Feel free to reach out to me. I'd love to have you help be a part of that.
Thank you, Stacy. And I'd be remiss if I didn't acknowledge, Michelle talked pretty eloquently about the support we've had broadly here. We've got to say, we've had incredibly supportive local government, support from the local government. Adam, maybe you could just talk for a few minutes, just tell us what you're doing and maybe speak broadly about the mayor's efforts.
Yeah, great. First, let me say to all the prior presenters and to everyone in the room who decided to come today to Hartford, welcome to the city of Hartford. On behalf of my partner and colleague, Luke Bronin, our mayor, my name is Adam Cloud. I am the elected treasurer of the city of Hartford. The mayor deals with administration and I deal with all the money. I'm the sole fiduciary for the city of Hartford's pension assets. And in that role, we make investments across all asset classes. And what I was so excited about is, as I saw some of the GPs in Insurtech with their funds, I would principally be an investor with them as an LP to help them allocate dollars to you guys who are the entrepreneurs in Hartford. What's unique about Hartford is that I've been treasurer for quite some time, 2011. Back in 2012, as the trends were happening around the idea of trying to create an ecosystem in Hartford, one of the things that I did is I created segregated about $40 million out of the pension fund for something called economically targeted investing, which is to, in essence, put slugs of $4 million in investments for things that happen in my backyard of Hartford, Connecticut, right? And why do we want that to happen? We want it because we want to see people like you in the room. We can't just, as a city, move without the strategic partners that have been engaged. Upward Hartford has been phenomenal. There has been a rebirth, and I'll tell a short story. I was in Chicago, and Rahm Emanuel and I were having a brief conversation, and he was getting ready to give a speech. And during his speech, he said, Illinois is the insurance capital of the world. And so he comes back to the table, and I go, sorry, Mr. Mayor, but we're not ready to relinquish that title yet. And the reason I wanted to make it clear about that is because with the history of insurance in this city, Hartford is the right place, and this is the right time for us to create the ecosystem. We're between Boston and New York. We're lower cost of living. We've got some of the highest level of education, whether it's UConn, whether it's Trinity, whether it's Conn College, whether it's Wesleyan. The talent is here, one. Two, you have never seen, I don't think, in any other city where the municipality itself is willing to put dollars, but also support in any way we can the kind of support to make sure that we thrive and that these businesses thrive. Because Hartford our motto now that Luke and I are focused on is we want to be the place where you can work, live, and play, okay? And that means if you need to be engaged with Shelbourne about finding a location to headquarter yourself, let's have that happen, which, by the way, I think the rent would be cheaper than it was in Boston and New York. Second, we're willing to put all of the resources of the city of Hartford to make your entry into this city as simple as possible. And if you ever have a concern, call the mayor, call me, and we'll make sure it gets done. Because Hartford, I think, is prime to become a center of this ecosystem simply because you have the client right here in the city. If you become part of that supply chain, with the support that's around you, the likelihood of success is there. And when you come out of that venture space, what I'm interested in as an LP is making sure that we're investing in the kinds of funds that understand you and are going to stand by you from birth all the way to your growth potential. So we welcome you, and I'm happy to engage anybody at any time. Come by the office, chat, or I'll come see you if you're here in Hartford, because your support, your success is Hartford's success. And so on behalf of the mayor and I, anything you need, you can count on the fact that we're going to be wildly supportive of everyone here.
Thank you very much.
Hey, Paul.
With that,
Paul.
Laura, I'm going to turn over to you and tell us
Actually,
what's next.
Laura, can I just ask? So I'm also representing Dawn LeBlanc today, who could not make it. So just a quick plug to say, amongst all the other assets that we have here in the city of Hartford, the Hartford Insurtech Hub has been an accelerator here for the last 3 years in the city. And Dawn LeBlanc, my colleague who's running that, is actually immersed in making that program happen and hosting a special delegation from travelers amongst the startups that are over there as part of our third cohort. So she couldn't make it today, but is eager to find ways to engage with all of you. And we'll add one more date to your calendar, May 12th, which is demo day for the third cohort of the Hartford Insurtech Hub. So just wanted to get that in there. Thank you.
Yeah, thanks, Michelle. And in the spirit of access and connection, this is the part where we're going to go back down to the 5th floor. So before we do that, just a few more things. If I could have the panelists please stay. We're going to do a nice photo for you. But all of you who have pre-selected companies to meet with, you should have received that schedule yesterday under my copy on email. So check for that in your inbox. Those who have not had the opportunity to pre-select with companies, they are eager and happy to meet with you downstairs. So it's not that you don't have the opportunity, it's that you're just going to make that opportunity happen. So to get from where we are right now on the boardroom, there's going to be a few of us leading back down to floor 5. Those meetings start in 5 minutes, and we want to be mindful of everyone's time. So if we could make that happen, it would be much appreciated. And again, thank you all very much for being here, for taking the time, for traveling all the way in from Israel this morning, for example. So it's important to us, so thank you.